Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. China's GDP growth beats expectations as exporters front-load shipments to get ahead of US tariffs. But the full trade impact is still yet to come. Tariff talks between the US and Europe appear to stall, with sources telling Bloomberg that Brussels is not expecting levies to be removed outright. Plus, chip troubles. ASML's first quarter orders fall well short of estimates. This after Nvidia slumps on new China export restrictions from Washington.
And a quick check on those markets, because that very line on the chip story is already weighing on both sides of the Atlantic. I'll kick it off with your stock 50 futures down about 1.6% following the risk-off sentiment you're getting from Asia as well. But the real pain is in NASDAQ futures. That Nvidia story really hitting it hard, down a whopping 2%. A pin and a floor when it comes to, or actually maybe a ceiling when it comes to the dollar. Euro dollar hovering at 113, and gold hitting yet another record. The countdown to the opening trade starts right now.
Wednesday morning, good morning. The chips are down for this Wednesday session. We'll come to that in just a second. UK CPI is breaking right now, coming through a little softer than anticipated. The year-on-year number, CPI for March, down at 2.6 versus 2.7 being the survey number. So it'll be interesting to see how the Bank of England reacts from that. That number's coming down from 2.8. Anyway, let's park that for a minute. I want to come to the main story of the day. As I say, the chips are down. You've got an ASML story that's making an Nvidia story already worse this morning. So Nvidia's down. The H20 chips are now restricted going into China. Nvidia's quantifying the impact that that's going to have on its numbers, and it is substantial. You then got ASML out this morning in the chip equipment manufacturing space. The numbers that it's revealed this morning out of Amsterdam look okay. The problem is, Anna, the forward booking numbers don't.
Yeah, the forward bookings don't. And I was listening to the CFO and the CEO on a little video they put out with the results, talking about where tariff uncertainty falls. And basically it comes down to some direct effects, which are on what you can export to the US in terms of equipment and on parts. Also, the equipment they send to the US to make chips in the US could be caught up in the tariffs, which I find really interesting. But then on the other side, they say it is too soon. There is no way to tell what this will do to GDP and therefore the secondary impacts on their business, overall chip demand as a result of this.
Well, the ASML story is one piece, but the Nvidia one is the other. And you had mentioned this in the headlines as well. It's fascinating to me that now we're looking at chip restrictions on the H20 chip. For our global audience, that's really important because that was the exception to the rule under the Biden administration. Jensen Huang had specifically made the H20 to circumvent the government restrictions down in the United States and not give that kind of crucial technology to China. And they're getting hit again 24 hours after making this gigantic investment in the United States in terms of manufacturing.
So the timing, I think, is really interesting here, because the Nvidia's stock got bid up at the beginning of the week quite aggressively on the back of some of this news. So you come in at the beginning of the week, you've got the Trump administration over the weekend scaling back potentially some of the tariffs around chips. So that's kind of one big impact, takes the stock a little bit higher. Then you get, as you say, this announcement coming through. Trump's praising Jensen Huang. He's talking about the investment coming in. It's all looking fairly good for Nvidia. But in the background, actually, all this other stuff is already happening. So from Monday onwards, we start learning, actually, that the H20 chip is going to be restricted. Nvidia takes a few days to come out and figure out what the impact of that is all going to be, and then reveals the numbers. How on earth do you trade a stock that is 2.3% of global market cap when you have all of these factors coming in? This is a stock that is basically the size of Germany's stock market. And it's being whipped around by all of this tariff news.
The regulation risk around this business is incredible right now, because we've gone from a position where there was a lot of concern about how China was training its AI models, and now the US is clamping down on the way that China inferences using these models, and that's where the H20 comes in, which is a deliberately depowered chip, so that it wasn't supposed to be that kind of threat. Anyway, that's where we are on that particular China angle this morning as it pertains to chips. But futures are down, NASDAQ futures down, E-minis down as a result of all of that tech news. We also have, though, running alongside that, some other Chinese news flow, which we should factor in. We have, backward-looking, some decent data out of China, don't we? But it is backward-looking. It is trying to get ahead of the tariffs. So for that reason, do we not really take it too seriously this morning? There's a lot of talk in the Chinese media about whether the PBOC needs to decrease rates and talk of toolboxes and all things being on the table. So we'll keep watching that, of course. I'm also interested in how the tariff conversation has been rolling on and what Trump is trying to do, what President President Trump is trying to do around tariffs now, talking about critical minerals, and that takes us to China as well. And is there really the possibility of producing all of those critical minerals in the United States?
I'd say this bit I don't understand. I thought China was restricting exports of critical minerals, and now you've got Trump tariffing
imports.
Is that tariffing? Is that the right word?
I think so,
Maybe,
yes.
on the way into the United States.
Yeah, it's a word now.
Yeah.
He's already introduced some emergency powers which are supposed to help the funding of domestic production. So it does seem to be the case that you can produce this stuff
but it takes a long time.
Yes.
Refining it is a massive issue.
Yes.
It's a highly complicated process that China's basically cornered.
Well, the believability of this data set is fascinating, though, as well, because so much of it is kind of front-running the impact, right? I was doing a real estate panel last week, and real estate is not something that I necessarily pay a ton of attention to in terms of the nitty-gritty, but they said that some of the juiciest deals in real estate right now are warehousing. Like, that's the investment that people are making in terms of warehousing all of this stuff that people are basically hoarding ahead of tariffs in various sectors, and that's where the moneymaker is in real estate. And I think that's fascinating because so much of that seems like a temporary trend because once the tariffs hit, it'll all stop.
One of our regular viewers messaged us yesterday to say, flagging one Bloomberg story that involves this, where you can basically put things aside in a warehouse without paying the tariffs yet. Complying with...
Don't you?
Yes,
Put it
exactly,
into a bonded warehouse.
Yeah, so it complies with their customers.
But you're going to need a lot of bonded warehouses. Apparently Volkswagen is also kind of going through this process as well. In the hope, maybe you just park them at the quayside, hope that the tariffs are limited, then you can kind of release them all in a big sort of flood into the... I don't know. I don't know how you manage the business.
And that's just the China piece. Then you have to factor in the Europe piece as well. And it feels like the news flow around China is moving in hyperspeed, and the news flow around Europe is maybe moving whatever, what's the opposite of hyperspeed? Slow motion,
backwards.
I guess? Yes, backwards. This idea that very little tariff kind of progress has been made in talks. I believe Sefcovic was in D.C., and the talks we got out of there in terms of D.C. to Brussels seems quite muted. But then you get a little bit of a different response when you hear the kind of commentary coming out of like Carlos Cuerpo out of Spain, or even Giorgia Meloni, who's looking to make her mark as soon as tomorrow.
Yeah, so the Spanish saying they had a conversation with Scott Bessent and they got some positive mood music, at least, about the possibility of a deal. But yeah, Sefcovic, our reporting around Sefcovic's visit, saying that they've really very little idea of what the US administration's aims are right here. They made very little progress, and they see very little chance that tariffs will be dropped anytime soon. So it doesn't set
we get to the end of the 90
progress.
days and basically we're kind of back to where we were. Japan, I think, is the real benchmark for all of this. So Japan, in theory, should be one of the best positioned countries to get a trade deal done with the United States. You've got those negotiations are kicking off. If there's signs of progress, I think the market will take that very well. If there's no signs of progress, and even Japan will struggle with this, then I think the market will take that very badly. So quite kind of big tail risks on either side of that Japanese negotiation in terms of what it's going to tell us about where we are with all of these negotiations the Bessent is talking about.
It does seem, yes, as reading on the terminal, some colleagues talking about this as quite the litmus test, the Japanese case for what can be achieved here. It goes early and it's seen as very significant. Involves a lot of cars, of course, as well. So we'll watch that one with interest.
We've got some great guests lined up. We need to talk as well about what is happening in the bond market. All kinds of interesting things are happening there. Val's going to update us on that very shortly. We're going to take as well from James Athey, who loves this kind of stuff, from Marlborough, the fund manager. We'll get his take. Kieran Nadra, Jupiter head of equities, is going to be joining us. Evie Hambro is going to be joining us a little bit later on. We're going to be talking about, we'll talk about the critical minerals sector with him. We'll talk about what's happening with gold. It'll be interesting to get his take on all of that. And Jumana Salahin, Vanguard chief European economist, is going to be joining us. I think we've got an ECB meeting tomorrow, don't we? That seems to be creeping up on me.
Yeah, buried in the news. But that's tomorrow's story. We got a full 24 hours before we have to deal with that one. Plenty of data to keep us company in the meantime. 1:30 p.m. UK time. If you are worried about the U.S. consumer, early signs of kind of nervousness, the retail sales numbers today will give us a little bit of indication of where the U.S. consumer is tilting, plus the Bank of Canada rate decision. This one's interesting. At 2:45 p.m. UK time, do we start to see some sort of insurance cuts emerging when it comes to the central bank reaction function? More divergence, perhaps, from what Chair Powell says. And then, of course, at 6:30 p.m. UK time, Chair Powell speaking to the Economic Club of Chicago about the economic outlook. Do we see some softening in his stance? As recently as last week, the answer was no. And then you were quite interested in this earlier. 9 p.m. UK time, Treasury tick flows for February.
So Val was telling me that this is February numbers. So you are on, like, if the Chinese were selling, it will not be showing up in this data because it's too rearview mirror. It's a few months back. We've got to wait a few months before we start to see some evidence maybe that the Chinese are selling. So it's going to be interesting, but it's not going to be... there's more fun to come, basically, on that story.
OK, we wait and watch for that one. Interested in Powell speaking, of course. Interested in anything that gives us more clues about the strength or lack of for the consumer in the United States, because the messaging out of the banks so far, we talked about this a bit yesterday, but we got more information, more detail on it yesterday from a couple of other banks who do have their finger on the pulse when it comes to the US consumer. Didn't seem to be suggesting too many cracks, but other voices I heard yesterday saying there were some. So, mixed messaging around the US consumer.
Mixed messaging, a little bit of caution, perhaps not as loud of recessionary warnings as coming out of David Solomon and Jamie Dimon, but still kind of, to your point, showing up in the background. I thought the fact that mortgage kind of loans were brought up a couple of times in the phone calls, and this is something that, even though we may not be seeing an actual change in terms of kind of consumer behavior, we are seeing a lot of volatility in the long end, of course, which is showing up in the fixed kind of mortgages that you get. How quickly does that kind of show up in the reaction function? That was a warning that the banks issued yesterday. Yeah,
we've been speaking for a long time about the advantage the US has, the consumer has, in fixing their loans for such a long period of time.
Not right now, they don't.
Not right now, no. Just back to the UK data this morning. So inflation comes in weaker than anticipated. Growth is coming stronger. So this is the data coming out of the UK economy at the moment is actually OK. And not much of a reaction this morning in the pound, 132.70 against the dollar. So you've got OK growth, the labour market looks all right, and inflation is below estimates. Yeah,
the big move in FX right now looks to be the dollar, doesn't it? Yeah. So difficult to sort of separate out the UK dynamic there, maybe. But yeah, dollar weakness in keeping perhaps with our top story this morning, which is about the weakness in ASML and the Nvidia story.
Yep.
And if part of the US exceptionalism that maybe people are clinging to is around AI, then the Nvidia news last night was quite a shock.
OK, so I've stripped... So euro sterling, spot 85.65, so you've got some weakness there.
Right.
But not much of a reaction around the data. What else do you need to know this Wednesday morning? Let's walk you through some of the other news that we are watching. Bloomberg has learned that the US has softened its demands for Ukraine to pay back aid. According to sources, President Trump's administration has reduced its estimate for the assistance provided to Kyiv from $300 billion to around $100 billion. That's quite an accounting revision. The revision brings it closer to Ukraine's own estimate, which is, let's call it circa $90 billion. United Airlines has taken the unusual step of offering not one, but two possible earnings scenarios going forward. The airline says its 2025 outlook remains achievable, but it's also warning that a recession could cut the profit forecast in half. Scott Kirby, the CEO of United, will be joining Bloomberg a little bit later on today, 1 p.m. London time. Look forward to that conversation. And President Trump has escalated his administration's fight with Harvard University by threatening to revoke its tax-exempt status. That's after the school defied demands to change its policies in exchange for billions of dollars of federal funding. Stripping Harvard's tax-exempt status would deal a significant financial blow, removing benefits such as avoiding property taxes and selling tax-free bonds.
Coming up on the programme, we'll return to the banking theme and things we have learned from the bank reporting season. Bank of America CEO Brian Moynihan says the lender isn't expecting the US economy to fall into recession this year. We'll dissect the latest forecasts and earnings from Wall Street later in the show. But up next, we will be joined by Mark Anderson, co-head of Global Asset Allocation at UBS Wealth Management. Lots to talk about when it comes to the tech sector in the US. If you have any questions, if you want to get involved in these conversations, IB plus BBTV Go, that is the function to use on the Bloomberg terminal. This is Bloomberg.
43 minutes to the market open, which is going to be dominated when it comes to European equities this morning by what is happening in the chip space. You can already see some weakness is creeping back into these markets. We'll certainly take a look at the AEX this morning. ASML is going to be front and centre. Let's talk about what else is going on. What's catching Kriti's eye this morning?
Well, Guy, we got to talk about the stock market, obviously. We're seeing this massive drop in the equity futures picture this morning, as you pointed out. But I really want to talk about what people are forecasting for the future, because you've seen Wall Street across the board start to have a massive price target cuts for year end. But if you look beneath the surface, maybe not pricing in that big of a hit when it comes to profits. And let me explain this. This is a chart that I think is very important. This white line is the blended forward PE ratio. So very, of course, obviously at the whim of these massive volatile moves that we've been seeing. And you can see that reflected in this gigantic drop that's akin to something of the steepness and the kind of sell-off that you've seen back in 2020. That being said, take a look at what the EPS is doing. That's what this blue line is. It has barely budged. And this idea that a lot of these companies, these massive S&P 500 companies that have so far been able to not really been massively suspending their guidance, suspending their buybacks yet. That seems to be the tell that we're waiting for. They also have massive profit margins. So even if they are able to absorb some of the costs, it doesn't hit their earnings as much as perhaps the market had initially expected. At least that's one take on perhaps why the EPS isn't showing. But I bring you right back to what we saw over in 2020, arguably over in 2018 as well, whereas some of that pain that you're seeing in the PE ratio takes a little bit of some time to show up in those EPS estimates. Guy, we're not there yet, but maybe we will be soon.
Everybody's watching it super carefully, Kriti, because so many people are just long US assets. Long the stock market, long the bond market, long the dollar. Let's talk about where we go with that trade. Mark Anderson, a co-head of Global Asset Allocation at UBS Wealth Management, joins us. Mark, great to talk with you. You guys, in some ways, in so many ways, are about wealth preservation. And I'm wondering how you do that in a world where US assets are being stressed and the dollar is being stressed.
That's obviously the million-dollar question that we try to solve for every day, Guy. And I think the main component of that is a multi-asset diversified portfolio. But some of the struggles we are, of course, seeing is when we are in this bit more of a, call it, stagflationary environment, where it feels relatively certain that global growth, and particularly U.S. growth, will settle at lower rates in the second half of the year, where we're going to see this positive inflation impulse. That's something of a headache for us, obviously, because traditional stock and bond correlations end up being a bit more positive, meaning we're not really seeing bonds rallying as much as we would like to see in this environment where equity markets are struggling. So a lot of the work that we're doing at the moment is trying to find some of these alternative assets, safe haven assets that will be doing well in this type of environment. Gold is obviously something that has been very much followed, but that's also something that has become more of a, call it, cornerstone in some of our clients' portfolios. There's a lot of questions around if the US dollar should be that 100% benchmark that's been for a long time. So when we talk to clients around the world, be it in Latin America, Middle East, or similar, that 100% US dollar benchmark has been very ingrained in the way that people have been thinking about portfolios. And that's definitely being revised at the moment. And those are the conversations that we are having with clients.
So where do you go from that? Where do you go from that 100% dollar benchmark? Where does that take the portfolio?
I think what you need to think about is that if we're in a world where the US dollar will no longer maybe be considered the same safe haven that it has been in the past, we have to think about maybe a mix of some of the alternatives. I might be coming across as slightly biased sitting here in Zurich, Switzerland, and talking about the Swiss franc, but the Swiss franc is certainly something which continues to strengthen, is a place that people are looking for. Europe might not have sort of 100% safe haven status for sure, but maybe some euros in a portfolio makes sense, maybe some degree of yen, and then obviously depends on the individual clients' future liabilities, which is something we take into account as well once we try to put that benchmark together for clients.
Mark, you mentioned some of the correlations earlier between the bond market and the equity market, that they are often going to kind of to one or to zero there. Talk to me a little bit about where the dollar correlations show up. If the dollar is a risk asset, not a risky asset, well, maybe a risky asset as well, but specifically a risk asset, are you seeing it move more in line with the bond market or the stock market?
I think what we could be seeing now is obviously, so first and foremost, I think it was a bit to the red thread that you were talking about before. There's just global investors around the world that are really piled into US assets, be it US equities, bonds, private market investments, where you're holding US dollars as a very natural part of that. In a world where we'll be seeing deglobalization, maybe a less sort of fortune moment for some of the US global companies, there will certainly be a little bit of a move out of that, and therefore also the US dollar. And maybe back to the correlations again, because what we could end up seeing now with US Treasury having sold off, that's of course a very uncomfortable moment, something that Scott Bessent has focused a lot on, not seeing sort of the back end of yields moving higher. So if things were to get out of control, so to speak, in the treasury markets, and the Fed or others would try to dampen some of that volatility, the only valve in which that you could see markets move would really be a weaker US dollar. So I think that uncertainty around the US dollar is definitely pushing it down these days.
Mark, OK, so something we continue to watch around the role of the dollar. Can I pivot from the dollar to US stocks? We've got US stocks under pressure this morning. Futures seen lower. Part of this to do with some of the concern around Nvidia and what it said overnight about a write-down there in its valuation. I know that you recently upgraded US stocks to attractive. When you hear things like that from Nvidia, how concerned are you about the attractiveness of US stocks right now?
So U.S. stocks are definitely under pressure, and it's coming from a lot of different angles. I think we're seeing earnings downgrades. We basically have flat earnings growth for this year in sort of a world where we see the U.S. economy growing clearly below trend this year, and with sort of a heightened recession risk as well. However, what we tend to like at the moment is that we're coming from a period of high uncertainty, volatility levels. Indices like the VIX is definitely very high. So these are also moments where you at times see opportunities in markets. You have to be very careful in how you're phasing into markets and how you're exactly doing it. But what we could see is a news flow that in this highly uncertain environment that will gradually be getting better. And one thing is definitely on the tariff side. We will have one day when news flow is great and everybody's happy, then a bit like overnight, it turns the other way. But in general, we think that news flow would be slightly more positive. And then we shouldn't forget that we have also U.S. administration that's going to pivot at some point and talk about tax cuts, deregulation, etc. So as much as things are uncertain right now, we're trying to protect some of that downside in markets in very short term. 6-12 months out, we might actually be in a better place.
OK, I mean, I suppose the risk there, Mark, is that instead of spending 90 days doing trade deals, we just get more sectoral tariffs. We don't get those trade deals. And maybe we see Congress slow walking the tax changes, and we don't get that either. I guess that's the downside risk.
No, that's the downside risk. And I think there is a significant downside risk if sort of deals are not being made as well, right? So if we hadn't had that 90-day pause on tariffs, I think we would have been looking at a global recession that could have been relatively deep. And that's a place where you definitely don't want to hold stock. So a lot of the assumption of equity markets still creeping a bit higher towards the end of the year is under this premise that we both avoid a recession and we're going to see more deals. And we have a target on the S&P 500 of 5,800 towards end of the year. But as said, in the very short term, we could see a little bit further downside before we get on that trajectory.
Mark, where does that tell come from? In terms of the pain for the S&P 500, a lot of those corporate companies, is it a hit to liquidity? Is it a hit to profit margins? Is it a hit to earnings? Where does that actual pain come from in some of the balance sheets of corporate America?
I think first and foremost, definitely earnings. If you see a slowing growth environment, we used to have estimates that whenever U.S. GDP falls by 1%, you'd see corporate earnings drop by 7 to 8%. So there's really sort of a multiplier, a significant multiplier to earnings on the back of how the economy is doing. So that's the first important point. Secondly, obviously, when it comes to being able to tap into credit, if we were to see more big banks calling for recession, of course, they would be more reluctant to lend. We've already seen that credit spreads have started to move out. So credit was very, very cheap to come by if we go a couple of months back. So spreads on U.S. high yield was at sort of historical lows at around 2.5–3%, now up around 4%. So it has been getting more expensive to lend as well. That's clear, and more difficult.
All right, Mark Anderson, co-head of Global Asset Allocation at UBS Wealth Management, joining us from Zurich this morning. A pleasure to have you on the program. He there was talking a little bit about how the credit story may be affecting the stock market in terms of leading that. That's a conversation we've had in the last couple of weeks, certainly. We're going to continue that conversation on the Treasury market and the ripple effects there. Coming up, the dust settling on last week's bond sell-off. We're going to dissect the long-end yields with Marlboro's James Athey. That conversation next. This is Bloomberg.
Welcome back, everybody. 7:30 here in London. Let's have a look at the futures picture for you. And the European futures picture tells part of the story. In fact, we should work out what's going on in Amsterdam, shouldn't we? We have ASML expected to be significantly weaker this morning as a result of their numbers and the Nvidia link. Overnight, we've heard from Nvidia talking about a $5 billion write-down. That is certainly weighing on US futures. I can see that Nasdaq futures is down by more than 2%. E-mini is down by 1.3%. So that's a big area of focus. Meanwhile, things look relatively calm in Treasuries. So what does that mean for bond markets here in Europe? With that in mind, let's have a look at where we are. Not a huge amount of movement, perhaps, then, at the 10-year horizon for European government debt. But let's talk about the US debt market. US government bonds are gaining after a Treasury official suggested a rule change to lower trading costs for banks. Let's bring in Bloomberg's Valerie Teitel with the details. Val, what's happening here?
Anna, another session of calm in the Treasury market. This time the rally was led by the belly. That five-year sector outperformed yesterday, and those five-year yields are now down nearly 21 basis points to start the week. The kicker for yesterday was this chatter from a Treasury Department, the Deputy Secretary of the Treasury, around loosening bank capital rules. Now, this is important, Anna, because this could really make banks the next marginal buyer of Treasuries if, for instance, they do reduce those risk weightings on U.S. government debt, which has been quite penalizing maybe since the crisis. The banks have had to hold other assets against their Treasury holdings because of their high risk weightings. If they do reduce that, it would definitely give lenders more capacity to hold those Treasuries on their balance sheet. And maybe perhaps that this reform has been pushed to the top of the agenda for the U.S. Treasury Department because of the slight destabilization in the Treasury market last week. Now, Anna, maybe those U.S. lenders can be the next marginal buyer of the Treasuries because we're definitely going to need one. Take a look at how the U.S. Treasury market is set to really expand over the coming years. It's expected to hit $30 trillion for the U.S. Treasury market size, reaching nearly $40 trillion by 2030, and in 10 years, reaching $52 trillion. So the market is really thinking about where the next marginal buyer for these Treasuries could be if, for instance, we have the big buyer like China stepping back.
Valerie, thank you very much. Bloomberg's Valerie Teitel with plenty of food for thought for us and for James Athey, fund manager at Marlborough, who joins us around the desk to talk about Treasury markets and much beyond. James, nice to see you. Making it easier for banks to own more Treasuries at a time when the government is going to be putting a lot more Treasuries out there into the market. Is that it? Is that issue of last week done? No more big surge in 30-year bond yields. Hedge funds have somebody to sell them to. Is that the end of that story?
I mean, it clearly helps. It's something that's been mooted for a while, and quite clearly this is something we've seen in the past, that governments find a way of regulating institutions to buy bonds when there are lots of them to be soaked up. Is it all problem solved? Potentially not, because, of course, if we do find that there is a secular shift away from US assets in general and a secular decline in sort of foreign support for and desire for foreigners to own US Treasuries, then potentially that could, put more pressure than the banking system in the US can soak up. So in that situation, I still think the central bank is the answer.
And what do we think the role of China will be here as owner of Treasuries? Because clearly lots of people say they won't want to shoot themselves in the foot by devaluing the thing they own a lot of. But at the same time, they might not be minded to buy all that much more of it, perhaps. So where does that leave China and its role in Treasuries?
I kind of think the China thing's been a bit overstated. China's not really been a massive buyer recently. Certainly what you see in terms of China's holding is as a percentage of outstanding Treasuries, it's been in decline for years and years and years, and it's actually relatively small. I think it's about 3% now. It was 14 at the highs, and it's about 3% now. A lot of that is obviously because they've been diluted because so many Treasuries have been issued over the last 4 or 5 years. But China in isolation could be significant. I don't think it's the most significant factor, and certainly, to your point, I don't think they're going to go out of their way to use sort of Treasury selling as a stick to beat the US with, because that could easily blow back on themselves.
Something we don't have to worry about then, Guy.
No. James, when do you think the Fed starts buying Treasuries again?
Yeah, exactly. I mean, ultimately, that's where all roads seem to lead. It feels a dangerous thing to say when the dollar is behaving so badly. Yeah. Because that was always the fear with this sort of financial repression, this sort of debasement, was that it would undermine currencies. Again, something I've talked about on multiple occasions. What better world for precious metals than when you have these sorts of policy choices? Lots of roads lead to no.
So sell Treasuries, buy gold?
Yeah, I mean, certainly I'd buy gold. I own gold, and I think it should be a decent portion of people's sort of balanced and diversified portfolio. When does the Fed get to buying treasuries? I mean, who knows? What we know is that they can go from, no, we're not buying treasuries, to, yeah, we definitely are, and we're doing it in size in the blink of an eye if the conditions align.
So there feels like there's going to be, if the Fed does ultimately step in and there's ample liquidity and buying, et cetera, there feels like there might be a period of time where there's still massive issuance from the Treasury and fewer buyers. Is there a question of digestion in this bond market?
Yeah, I mean, we've had that over the last 5 years, Kriti. What you see is that who's been buying US Treasuries has shifted quite dramatically over the last 10 or 15 years, and particularly post-pandemic. It really was the domestic US investor that was having to pick up the slack, because lots of the other non-US investors and buyers that we'd become accustomed to supporting the Treasury market weren't, for various reasons. Those reasons ebb or flow. Treasuries are always bought. Every security is always owned. Of course, the question is, does the clearing price need to decline in order to sort of encourage that participation? And that depends on lots of things, not just what the president is doing around tariffs, but of course what the economy looks like, what inflation is doing. There'll be significant contributors as well.
So I hear you on that trend in the last 5 years, but given all the volatility, the last 10-year auction saw record indirect takedown. Can you just explain that? At a time when we're talking about a lack of credibility in American assets, why do you see the opposite reaction function when it comes to some of these auctions?
Well, I think the lack of credibility in American assets is probably going a bit too far. I think what we saw was a pretty unsustainable extreme of ownership of US assets, foreigners owning US assets in sizes that have not existed in the past. In my personal opinion, actually, it was the equity market where the overhang was most unsustainable. I think the reality is that investors would have looked at uncertainty, equity weakness, volatility, potentially significant economic weakness, potentially Fed cuts, and rising Treasury yields, and said, that doesn't make a lot of sense. I'm quite happy to take the other side. We might be talking about a bit of a shock in terms of uncertainty in US policy, but are we talking about Treasuries truly losing their sort of status as a haven? I don't think so.
OK, that's interesting. Looking at the dollar, we see more dollar weakness this morning, and you've talked about the potential energy that there was in the long dollar positions that we saw running up to this period of tariff frenzy. How far through that potential energy are we, James? Has some of it been given back?
Not very far. I mean, again, the data on this stuff is pretty lagging, so we don't really know yet, but we will find out in the coming weeks and months the extent to which we've already seen a shift by foreigners. And it's not, I wouldn't think of it as a sort of FX trade. It's not like everybody was long the dollar and that's the potential energy. It's that everybody was long US assets, and that includes being long the US dollar. And so think about it. If you're a Japanese investor or a European investor, and you've got a significant weight in equities, and you've got a significant weight in US equities, and you don't hedge your currency, because equity investors don't tend to, you know, equity market goes down 10%, that's bad. If the dollar goes down 5% at the same time, then those losses add up real quick. And everybody's been used to the opposite, this virtuous circle whereby US equity values rise, the US dollar rises, and for foreign investors, that's been, you know, fantastic. If that goes into reverse, it could be significant.
Year to date, the S&P for US investors is up by 6.83%. For Euro investors, it's down by 0.26%. You're negative.
There you go.
Can I just come back and talk a little bit about what you said about what is driving Treasury demand and who's buying and why they're buying?
Yeah.
Are we now at the point, though, where, particularly at the longer end, that the economy doesn't matter? That this is just a balancing of buyers and sellers, and that's where the challenge now lies. The challenge that the US Treasury market now has is finding enough buyers, regardless of kind of what the economic data is doing. Is that where we've got to now? It's so big that it doesn't really matter what is happening with everything else we've traditionally associated with the Treasury market and its predictive powers of what is happening in the US economy. That doesn't matter. This is just about the quantum now.
I wouldn't go that far, but certainly we're moving in that direction, right? And again, the long end of the curve is the most disconnected from what's happening today, tomorrow, what's happening in Fed policy, et cetera, et cetera. That's why sort of curve steepness, I think, are a popular trade. We've been avoiding the long end of the UK and the US and Germany more recently for all these reasons. A lot of the things that we spend all our time talking about and trying to understand, uncertainty, inflation, supply. A lot of these things are most likely to be negative for the long end. You know, if you're looking at 2 to 5 year treasuries, it really matters where the economy is going this month, next month, 6 months' time. It matters what the Fed is doing. But yeah, sure, at the long end, those things are less relevant. And obviously, those securities are much more volatile in price terms. So I don't think we're as far as saying the economy doesn't matter, but we are potentially in a situation where there is a really significant segmentation of the curve, and you need to express.
Is this an LDI situation? Are there comparisons with the UK and what the UK has been through recently? Are they useful for what we're seeing?
Well, what we saw there is that essentially when you get a lot of investors rushing for a very small exit door, things can get messy very quickly. And of course, that is a risk here with the Treasury market. It's bigger, it's more liquid. We all know the gilt market is badly behaved at the best of times. But sure, you know, there are risks that we could end up in a situation of forced selling or, you know, significantly encouraged selling, just forcing other investors to do the same.
All right. James Athey, you paint a sunny picture for all of us. Fund manager over at Marlborough. I'm going to say that right. We thank you so much. Coming up on the program, we take a look at European chip stocks after the Trump administration imposed new restrictions on Nvidia's chip exports to China. Futures, of course, tanking both sides of the Atlantic on that. More in today's Stocks to Watch coming up next. This is Bloomberg.
15 minutes from the opening trade, cash equity trading. Futures are ugly. They're ugly over here in Europe. They're really ugly over in the United States. Take a look at NASDAQ futures, gap lower and have continued to roll over as the session has gone on. We're down now circa 2% on the NASDAQ this morning. In some ways, 2% doesn't feel like a very big move. You've got all kinds of things going on at the moment. We've seen bigger moves, certainly, over recent weeks. So we'll see how the day progresses. But it started ugly and has got uglier, Kriti.
It's fascinating because a viewer actually messaged me about this. I think I had called the futures sell-off earlier a gigantic futures move, and he said, actually, to your point, the volatility isn't really there. It's only a 1 standard deviation move. It's crazy that we're in that life, that a 2% drop is only a 1 standard deviation move in the futures picture. But as you say, some of it is coming from the States. The other piece is coming from China as well. Commerce Bank cutting its forecast for Chinese GDP growth to 3.8% for 2025. Follows a similar move by ANZ to about 4.2%. And yesterday, by UBS as well. Official figures out today indicating China's economy showed surprising strength in the first quarter. Let's dig into the numbers here. Alan Wong, Bloomberg's China economy and government editor, joins the program. Alan, walk us through some of the key numbers here.
Sure. The top number, the headline number for GDP for the first quarter was 5.4%, which in normal peacetime is a very respectable number for China's growth. But now there's a raging trade war, so that number is very quickly discarded because the number captures the state of the economy in the first 3 months of the year, and Trump's massive tariff only increased this month. And if you look at higher frequency data earlier this month, we could see that there are signs of China's export engine slowing because cargo data showing a slowdown in the volume of goods that they processed last week. And on top of that, if we just look back at the first quarter, we saw very strong retail sales growth as well as industrial production. Those were numbers that were at their 1 and 3 years high. So very rosy picture for the first quarter. But again, I think investors and markets, they are just looking ahead to see the impact of the tariffs. And we've seen downgrades coming just after the GDP was released. So that goes to show just how much people have moved on.
Yeah. And I'm sure there was probably some front-loading in some of this data as well. And as much as people were trying to get ready for the tariffs to arrive, they were pretty well telegraphed. Where does that leave us, Alan, in terms of the stimulus conversation? Where does that come from? When do we get it? When does it happen? We've been talking about it, it feels like, for a very long time. But if ever there was a moment, this feels like we are getting into it.
Yes, we have talked about it for months now, and the government has promised that they'll do something. And a lot of economists expect some monetary easing later this month. And the rosy data, in normal times might give policymakers some sense of security. But this time around, I think the market consensus is that the government realizes just how challenging the external environment will get. And therefore, we also saw from the Statistics Bureau also just highlighted just how difficult things might get from here and emphasized the need for some support for the economy. So the consensus is still that we will get some form of easing and potentially support measures for the economy. In what form and exactly when, that remains a massive question mark.
Alan, thank you very much. Thanks for joining us. Alan Wong, Bloomberg's China Economy and Government Editor. Joining us now to talk about the markets in 3 minutes, our Markets Live Executive Editor, Mark Cudmore. Mark, all roads seem to lead to weak technology risk appetite this morning. We've got ASML giving us negative headlines around bookings and unable to quantify the impact of tariffs. We've got Nvidia talking about a write-down in its value, and NASDAQ futures off 1.9% at this moment as a result. This is taking the tariff story and the decoupling US-China story on another step, I suppose.
Absolutely, and I think you've cited the kind of main reasons there. The China-US trade war is back at the forefront. Nvidia negativity, ASML negativity, but we've got to remember that these moves are quite small compared to what we've seen most days this month. So this is not too dramatic. The backdrop here remains very negative, and we're expecting more losses for US stocks in the months ahead. I think what we're really set up for is I do think the trade talks between BEST and Japan are very important today. They're very important globally, not just a Japan story, though they're very much a Japan story as well, because Japan is one of the countries with one of the largest trade surpluses with US. It's a major trade partner. It's been perceived as a very strong ally previous to this administration. So how will those negotiations go? I think there'll be a strong read across from how they go. If it seems like there's a perception that negotiations go relatively easily, Japan could strike a deal with mild concessions perhaps, or at least that's the sounds that come out of the meetings, well then people will be very optimistic that, hey, these threats from the Trump administration are mainly threats, they're mainly negotiations, and it's easy to move beyond them. However, if it looks like the US administration is going to play hardball in negotiations, that'll be very worrying to people, given that Japan has been such a staunch ally. If they're going to treat Japan harshly, what's going to happen to other nations out there? So I think that's the real big risk, and part of the negativity we're seeing in stocks at the moment is people want to lower their risk going into the long weekend in the US.
Sure. How symmetrical is that risk? If Japan looks like it can get a deal, what kind of a bounce do we get in terms of risk assets? If it doesn't, what does the opposite look like? And again, what is the symmetry between those two?
Great question. I think short term, the asymmetric risk is actually for relief. I think this is a market that is very nervous. And I think that they'll trade a positive story much more aggressively because people have got out of the market recently, at least short-term players. So I think short-term, the asymmetric risk is higher. I actually think that longer-term, people won't, trade as a longer-term story. I think the longer-term negativity will be there even if there's relief in the short-term, which means if there's a negative story today, that'll be really, really drastic in the longer-term because people already want to be long-term bearish. So short-term, asymmetric risk higher, long-term, asymmetric risk lower.
Mark, very quickly, is the dollar a risk asset now?
Great question, Kriti. I was worried you're going to ask me this. I think the dollar bounces after the Japan-US talks because there won't be a currency deal. That's separate from the success of the talks overall, which means dollar-yen will bounce and raise the Bloomberg Dollar Index. Is that good or bad for stocks? I'm not really sure. I think stocks are moving dollar rather than dollar driving stocks or risk sentiment.
That is something you don't often hear. Bloomberg Markets Live Executive Editor Mark Cudmore, we thank you so much. You get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we are seeing some calls lower on ASML this morning from the market makers following these worse than expected orders at the chip machinery giant. Now we can see this stock has actually already come down quite a lot from its peaks last year. It was up at around €1,000. We're already down to 600. And as I say, getting a pretty negative reaction today. And then there's the broader chips read across coming through from Nvidia, with that stock down sharply in the post-market, down 6% after hours following the US barring those sales of that specific chip over in the Chinese market, and Nvidia saying that could cost several billions of dollars in terms of their machinery orders over in China. Then we got Heineken not selling enough beer, apparently, according to their results. Beer volumes missing expectations by a significant amount. We can see that Heineken has actually been the underperformer versus the big rivals like AB InBev and Carlsberg that have done pretty well on their premium offerings. But Heineken set to be another underperformer today. Then, in terms of airlines, United Airlines jumping in the post-market in the US yesterday. A better-than-expected result from them and stronger guidance than expected. More resilient in the face of some concerns around the US economy. So that stock was higher, and we're likely to see a feed-through potentially in IAG, Air France, Lufthansa, though we will wait to see if the broader market trends kind of take over. But these stocks down a lot, potentially some upside in those. And finally, just a rating to bring you Novo Nordisk has a new underperform. Only the third broker with a sell recommendation on this stock around 30. It hasn't had a new sell on that stock for a long time, and that's over at Exane. They've actually got outperforms on most of the other pharma stocks, but Novo underperforming at Exane could put pressure on that stock this morning.
Joe, thank you very much. Our equities reporter Joe Easton. Another one to watch. I've seen some suggestions. Bunzl, the wholesaling business, could be weaker at the open, citing North America, but it does seem to be operationally specific to them rather than a story about tariffs, which comes as something of a relief at the moment.
Not everything was a tariff story at the moment.
Not everything is a tariff story, which there in itself is a story.
How do you separate? So ASML, you got ASML and you got Nvidia this morning, two stories. Nvidia came first. Would ASML have been down quite significantly even if it hadn't come out with numbers this morning? I don't know how you separate those two out in terms of the effect that is direct ASML in terms of the hit and how much of it is kind of broader Nvidia concerns.
And I think we get TSMC tomorrow as well, so that's another kind of factor, another region to think about. Going into the open, though, if you look at these futures pictures, the gap that you're seeing between the UK and the EU right now, the Euro stocks are down about 1.2%. FTSE 100 only down 0.4%. I say only, but that's a really tiny move.
Yeah, absolutely. I mean, defensive-laden, I suppose, the FTSE 100. Amsterdam futures down by 1.6% will bring you the opening price of ASML for sure. This is Bloomberg.
Couple of minutes to go until the opening trade, the Wednesday opening trade. I'm thinking about this as Thursday. We've got Friday off, so today in reality kind of is Thursday. Let's talk about where we are and where we're going. So this was a session yesterday. White lines Europe. We go up. We close near session highs. The US market falls after that. And as Kriti's about to tell you, it has continued to fall. And that is the concern going into the European session this morning.
Absolutely, Guy. We're setting ourselves up for a little bit more carnage. I'm going to start from Eurostoxx 50 futures because they are down about 1%. You compare this to what you're seeing in the UK, and it's actually not that bad here in London. Futures are only down 0.4%. So you can see a lot of the pain is concentrated on the continent. It gets even worse, though, as you look at more exposure to the chip sector. Anna's going to dive into that in just a moment. But 1.5% lower on the Amsterdam index. A lot of that in response to ASML, of course. And Anna, as we start to see that really magnify over in the States, already setting us up for 2% of a downside on the Nasdaq at the opening bell.
Yeah, absolutely. So Nasdaq futures are weaker. That's partly Nvidia, well, very much Nvidia, but also add into the Nvidia story, ASML. So we'll keep an eye on how that opens in just a moment's time here in Europe. The AEX futures down by 1.5% this morning, as we've been saying, as a result of the weakness in the ASML booking numbers. And they're really it's very difficult to work out the tariff impact for this business, it would seem. Heineken, we're also focused on that business. They put out some numbers this morning, and beer volumes shrinking. Late Easter hitting demand is the story there. We're also keeping an eye on what's going on in aviation. United Airlines providing two possible earnings scenarios, expecting, of course, some kind of hit if the US economy is going to go into recession. And so that could be something, Guy, we see from a number of businesses, that kind of option on scenarios ahead.
Absolutely, and Scott Kirby's going to join us a little bit later on to discuss. OK, here we go. Time for the market open this Wednesday morning. We're going to keep a firm eye on what is happening with the Amsterdam market. We put that in for you today. We are going to watch ASML very carefully, the epicenter of the chip action here in Europe today. The FTSE 100, as Kriti's been indicating, actually not falling very much at the moment. We're down by 0.2%, 1/10 of 1%. A much flatter appearance from the FTSE this morning than we're going to see potentially elsewhere. So the Stock 600 down by 0.3 of 1%. The IBEX is down 3/4 of 1%, but the main events have yet to happen. We're going to wait for the CAC. There it is, down 0.8 of 1%. We'll see how some of the chip stocks fare within that, but we're really waiting to see what the AEX does with ASML, and some of the chip stocks out of Germany as well could be affected. It could take a little while to get those markets up and running this morning, Kriti. What are you seeing below the surface?
Well, a defensive bid surely in the market, and I'm just waiting to see if we're getting some pricing on ASML this morning. It doesn't seem to be just yet a trading halt there, so some of the kind of plumbing the market's still working through. But you can see it right off the bat. Utilities are your outperformer. Even looking at the FTSE 100, National Grid showing up right at the top in terms of the index move to the upside, but pretty broad declines everywhere else. You're looking at the commodity sector taking their tune, Anna, from the likes of Brent, copper, etc. BP, Shell, Rio, Anglo, all taking a beating this morning.
Yeah, absolutely. So the fact that the FTSE is laden with defensives does play to its strengths today, but it's still down by 0.2 of 1%, but it's not down that much, given that basic resources is actually the worst performing sector today, followed by energy, Kriti, and both of those heavily represented, of course, in London. But that utilities bid away from basic resources and energy does seem to be lifting some of the UK listed names as well as utilities elsewhere. There's also some strength coming through in some grocery stores and some of those consumer staples. It is that classic flight to defensives, it seems.
Heineken's actually trading stronger. Its numbers this morning seem to be going down reasonably well. I wonder if that's a safe haven bid.
I was going to say, when things go bad, you just
buy beer.
Drink more beer.
I think we've had days where that's been the case, yes.
Yeah, a lot of them, it feels like, recently.
Just recently.
Going into a long weekend, maybe that is the right trade. It's going to be reasonably sunny. But the defence stocks are also trading higher as well. So that certainty, that visibility is maybe what the market is seeking out this morning, an understanding of where some of these stocks are going. Probably easier to understand in a name like Heineken or National Grid or Unilever than maybe like Nova's down. Joe was bringing us the downgrade there, but SAP, LVMH, Schneider, these are the kind of names that are certainly moving on the downside at the moment.
I was going to say the tech kind of read-through there, even though I know we're keeping a close eye on the chip sector, but the tech read-through, the likes of SAP, for example, or even, ASM International as well, which is different than ASML, of course. I always have to kind of remind myself that. Also trading down a whopping 5% at the open. We're still waiting for the actual open on ASML, but already you can see some pain, not just in the chip sector, but broadly in the broader tech sector as well. So how do you value something like that? In the famous words of Dan Ives over at Wedbush, if you trade tech on valuations, you miss out on the rally. We spoke to Kevin Gordon from Charles Schwab about how valuation analysis shows up in this environment. Take a listen to what he had to say.
The compression has been all multiple driven. It's been all multiple contraction. So a lot of people will point to the E component and say, well, forward earnings are still going up, so it's fine. I mean, you can't really rely on that metric. So if forward earnings estimates are going to continue to go up, that's actually going to put, all else equal, upward pressure on multiples. But of course, we know that's not necessarily the case right now. So I think it makes, similar to 2020 and 21, again, it makes valuation analysis not very helpful, if probably, just not useless at this point.
Let's bring in another voice here. Karen Nundra, head of equities over at Jupiter Asset Management, joins us around the table. You picked a great day to join us because I feel like when we're talking about a tech-driven sell-off, valuation, the question of valuation always comes in. You heard Kevin Gordon there saying that valuation is useless at this point. But at the moment where you're seeing such a discount, arguably, on tech, do you buy?
So I think for taking the point around valuations, that is absolutely really important. So I'm going to come to tech in a minute. But what we're seeing at the moment, especially when it comes to US equities, is that despite the sell-off that we've experienced, US equities are still trading at like 27.8 times the kind of Schiller PE levels. And that compares to far more attractive valuation levels elsewhere. So when I'm thinking about where we're looking to invest and where we're looking to put money to work, it's definitely been in that kind of European side. But in terms of where we're positioned in the European part of the market, that is much more actually on that value and cyclical part of the market.
So, Karen, as you were speaking, we just got the opening numbers on ASML. You can see it on your screen there, down a whopping 7% on the opening trade after that first quarter bookings miss. It brings this question, though, of when you're talking about tech kind of leading this market lower and having that cyclical position, is tech no longer a defensive asset? What would you categorize that as?
Well, that's a great question. So I suppose when we came into this whole crisis, tech valuations were incredibly, incredibly high. And this means there's been less of a kind of valuation buffer. And what we saw with Nvidia overnight has really shown, when it comes to the tariff war, how difficult it's going to be to actually move supply chains and for companies to kind of react to that, I would say. So that kind of inability to move supply chains, some of these supply chains have been put in place over decades, and that's incredibly difficult to replicate. And that's what we're seeing in the market now, that there's a kind of realization that that's going to be very difficult to deal with. But I think just coming back to your point on expectations, clearly there's that growth and the earnings consensus and the earnings expectations. But what we're really seeing here right now is a mismatch between expectations and what companies are delivering. And we saw that in Q4, particularly last year, where hitherto, tech companies have been producing kind of really strong earnings. Investor expectations were rising and rising, and companies were over-delivering. And Q4 was the first time you actually saw a balancing out of that. And I think that's made that valuation equation a lot less compelling. And this is talking about global tech valuations. Clearly, we're seeing a lot more I would say, room for that to compress in the US.
Does predictability carry a premium at the moment? If I can predict what a company's going to do I want to own it more at this stage?
Typically, you would say that, in this type of environment, those types of more stable companies are the types of companies that should be doing well. The problem that we've found, especially globally, is that those companies that have had those strong moats, that have been very predictable, those are actually the ones that have had the really, really high valuation levels. And that's what we're suffering with now. And in a rising inflationary environment, that's why we're seeing some of those more value and cyclical names start to actually outperform, because they've got that much more of a strong valuation underpin that those other stocks don't have. So I think do I want to own the cyclical, potentially going into a recession? So cyclical companies, if we think about value companies, I'm talking really about kind of value names here, and ones which are more domestically focused, those are the types of companies that we'll be looking at. So when I'm thinking about for banks, for example, in this type of an environment, actually we are very positive on banks, especially within the European space. Energy stocks are still looking pretty interesting, and that's despite, for example, oil doing what it's doing. If we look at the implied oil price in the valuations of energy companies today, we're seeing implied oil prices of $50. So typically, I would say in a normal environment, you would be wanting to go into those kind of more quality names, but given how expensive those names have been, they're more vulnerable than they would be otherwise.
How much, Kieran, how much are you taking money out of the US and putting it into Europe right now? How much of that is an overall theme for you?
Yeah, so we're already seeing some of that moving out. So if you think about just euro-denominated funds or European funds, in 2009, those funds actually had around 15% exposure to US equities. Today, that exposure is 45%. So I think given what's going on with that lack of certainty, I'm not going to get into, for example, the US dollar, but what we're seeing there, I think we are going to see a reallocation of assets away from the US and more kind of internationally diversified.
And that's just very much at the foothills of that trend, are we then? Because if Europe was so not overexposed, but in the current moment perhaps feels overexposed to the United States, there's so much more of that still to go.
Yeah. So I mean, look, to be absolutely fair, so the US has delivered up until the US has delivered since GFC, it's delivered 17% annualized returns with a 13% volatility. The Sharpe ratio of US equities has been phenomenally strong, and there is no reason really why anyone would have wanted to look elsewhere. I think that equation is absolutely changing right now, and I don't think it doesn't require European assets in particular to start outperforming. It's just that that diversification benefit of having lower correlations is just hugely beneficial for portfolios globally. So I think that's why we're going to see that move away from US and into other regions.
Yes. Are you buying into regionalisation themes then, as opposed to globalisation?
Yeah, absolutely.
Where do you see the best opportunity for that?
So we are definitely looking at, so Europe is definitely an area that we're looking at. And in terms of, those areas within Europe, it will be banks, it would be energy. And then we're also looking on a very kind of stock-by-stock basis. So those companies that had done well in dealing with COVID, for example, especially when it comes to kind of nimbleness of supply chains, that's something we're absolutely looking at the moment. And then even within Asia, so moving out of Europe, we still have an underweight to China. That's very much a longer-term position that we've had, notwithstanding where valuations are. That's still a position that we stick to. And I think the other thing I just want to point out is that there are certain countries which are almost too big to be small and too small to be big. And by that I mean that I think the Southeast Asia, I think, will have its own issues, but countries like India, for example, are still really interesting because they have their own structural growth drivers that are still very much intact, and they're just less dependent on global trade.
Great to see you. Thanks for stopping by to see us. Really appreciate it. Thank you very much. Kieran Undra, Head of Equities at Jupiter Asset Management. The Core 6 is having a fun morning. Let's take a look at some numbers and just show you what exactly is happening. You can see ASML is down, let's call it circa 6% at the moment. We've been down below 7%. LVMH is off, Novo's off. The chip space generally is under pressure this morning, but it's spreading out into more, you could argue, the data centre story. Look at Schneider down by 1.3%, but actually doing reasonably well. But the right-hand side of the chart, there's your safety trade. Nestle, Staples, doing relatively well this morning. Joe Easton's got more details. Over to you.
So ASML, Guy, really the big news today in terms of the sectors moving. We are seeing losses across the chip space today. ASML, as you mentioned there, was down around 7%. It was in a trading halt initially, now down 6%. Also seeing a feed through in peers, BE Semi coming lower as well, and VAT as well. Just a couple of the other chip machinery stocks coming down. Remember, the Nvidia decline as well, post-market in the US weighing on the sector. But the ASML order miss seems to be hitting the space today. Then Heineken does appear to be selling enough beer, apparently. RBC writing that actually the volumes were better than their expectations. So Heineken actually rising around 3%. Also over in Amsterdam, like ASML, of course. That one coming up around 2.6% at the moment. Rio Tinto was lower in Australia and lower in London as well. Their iron ore exports missing expectations. A bit of a weather impact, according to the report. The copper business actually doing pretty well, but that does seem to be weighing on the stock with the broader market declines as well. And then one that's even worse, one Anna mentioned earlier, Bunzl, now down almost 23%. This is a distribution company here in the UK, distributing food and outsourcing, that kind of thing. Slammed on very weak numbers, very weak guidance, and also not doing the buyback that analysts were expecting. So Bunzl, the worst performer across the entire stock 600 today, down 24%. Now for that one. And then another one slipping over in private equity, EQT, the exit rates in the last quarter not as good as expected according to analysts. Now that's a $30 billion company and it's coming down 6%, so a big move lower on EQT today. That one hit over in the investment management space. And then finally, just a touch back on Novo with that new underperform over at Exane, only the third broker with a sell rating on the stock, a 405 target, the lowest on the street. Still got some way to come down. We're at 420. Too much competition for obesity drugs is the view from Exane, and they think the cash flow isn't good enough either. So Novo slipping with the broader market, down 1.4% in Copenhagen today.
Joe, thank you. Joe Easton. We'll dive more into the tech themes coming up. The chip story certainly front and centre, following disappointing numbers from ASML and the escalating trade war, geopolitical concerns between the US and China. I mean, more limits on Nvidia. All of that conversation coming up next. This is Bloomberg.
Welcome back. 17 minutes into the session. Chips are down, definitely. Down pretty hard, to be honest. ASML under significant pressure. It's hard to separate out Nvidia from ASML this morning, but we're going to give it a bit of a go and figure out what is going on here. Our executive editor for global technology, Peter Elstrom, joining us around the table. we'll get to Nvidia in a moment. ASML, talk me through what they are. The concern seems to be about forward bookings. So are we starting to see the effect of a tech slowdown? Is this a tech slowdown that we're starting to see? Because in theory, it should start at ASML and kind of work its way through the supply chain.
Yeah, that's right. So ASML reported financial results that were not bad.
Yeah.
But as you alluded to, there was a real focus on their bookings. Now, bookings are kind of lumpy at ASML. Their machines can cost up to $400 billion.
They're huge.
People do book them, in kind of lumps. But what we're seeing is a pretty serious slowdown. Analysts were forecasting there were going to be bookings of 4.8 billion euros. Instead, they came in at 3.9 billion euros, almost €1 billion short of what they were expecting. That's a pretty worrisome sign already. And on top of that, the executives had prepared remarks where they talked about the tariffs. The Trump administration tariffs are creating additional uncertainty in the market. They're not exactly sure how that's going to play out in terms of demand for their goods. They did keep their revenue forecast the same for this year, but they cautioned that there's a lot of uncertainty in the market right now, and it's not exactly clear what's going to happen with those chip equipment orders.
So these are many millions of dollars of chip equipment that we're talking about here. Take us on then to some of the customers for some of these machines. That takes us on to the Nvidia conversation, perhaps. But the Nvidia conversation overnight is actually about what they're able to send to China and the export controls that have been now put in place. And this news came from a sort of strange place. It wasn't a big government announcement that you can't send H20 chips to China. It was a little bit more under the radar than that.
Right. It came through Nvidia filing, and they disclosed that they're not going to be able to sell these H20 chips into China for the indefinite future. So that is a caution from the Trump administration that they don't want Nvidia selling these chips that are used to train AI models to Chinese customers at this point. Now, note, this is the third series of restrictions that we've seen from the U.S. government towards Nvidia in particular. First, in 2022, the Biden administration restricted their most advanced chips. Then in 2023, they restricted chips that Nvidia had retooled to make available in the China market. And now we're seeing yet another set of restrictions. So this is a big blow to Nvidia's ability to sell into China. They said they're going to take a $5.5 billion write-down in this quarter, as they report later on. And over the course of the year, it could cost them $12 to $14 billion, according to analyst estimates. So it is a big setback. Nvidia would like to be able to sell into the China market. They're also worried that Chinese alternatives are going to get additional support from the Chinese government if they're not able to sell into the market. So they're worried about additional competition on that front.
Help me make sense of some of these numbers here, because we're talking about a $5.5 or $5.5 billion write-down, as you point out, the initial hit. At the same time as we're talking about a $500 billion investment into domestic infrastructure from Nvidia as well. That announcement coming 24 hours prior to this filing. But doesn't that just make the cost of chips more expensive if you're manufacturing them in the States?
Well, the announcement that Nvidia did with the Trump administration was a little bit different. They said they were going to produce $500 billion worth of AI supercomputers, as I recall. Now, they're not actually going to invest that amount of money. That's what they anticipate producing on the other side. But you're exactly right that these companies, Nvidia, TSMC before them, are pledging big investments in the United States, in part to build a stronger relationship with the Trump administration so that they don't have to suffer from these tariffs. It doesn't look like it's working in Nvidia's case, at least for this. We'll see how it plays out with TSMC and some of these other companies.
So what are we going to get tomorrow? What do we expect to hear from TSMC tomorrow? How big a moment is this going to be?
Well, investors are certainly on edge. As we see with ASML shares right now, we're seeing it with the chip stocks more broadly and tech stocks. Additionally, customers are very much on edge about what they're going to see from TSMC. They want to get some positive numbers. There are concerns that TSMC is going to take down their numbers and maybe also raise some concerns about these big investments in AI, whether they're going to pay off over the long term.
Peter, nice to see you.
Great to see you.
Peter Elstrom, Bloomberg's global executive editor for global technology, Kriti.
Let's go from the tech sector to the banking sector, because perhaps there's a little bit of nervousness and anxiety in the tech sector, perhaps a little more confidence in the banking sector. Bank of America's research team doesn't currently believe there will be a U.S. recession this year. CEO Brian Moynihan also sharing views on the U.S. growth outlook and rate path for the Federal Reserve.
Our research team, like many research teams led by Candace Browning, does not currently believe we'll see a recession in 2025. However, they've lowered their GDP growth rates for 2025 and continue to see no rate cuts during 25, but expect as inflation gets under control, you may see them in the future.
All right, Brian Moynihan there, the CEO of Bank of America. To get a little bit more context, we'll bring in our very own Charlie Wells, who's been covering the banking sector for us. Charlie, Brian Moynihan, Jamie Dimon, David Solomon, they were all very gung-ho on the U.S. economy. 2 of those 3 names pulled back. Why didn't Brian Moynihan?
You know, a lot of confidence. Trade war, what trade war? That was kind of, the outlook that we got there. And it was interesting, you heard from their CFO yesterday, too, talking about the resilience of the American consumer. And you saw on the Bank of America front, a lot of these kind of consumer issues pull through, right? So net interest income beat. They set aside less in loan loss provisions than was expected. And it's just seeming like, yes, there's a lot of talk about concerns about this trade war, but it's not necessarily coming through in those numbers. And so you kind of get this sense of, confidence, but of course uncertainty. So no recession in 2025, that's quite a statement.
Yes, a lot of unknowns still through 2025. We're only 16th of April, I suppose, and there's a lot still to play out. So where did that leave the banking sector then, as we heard it yesterday, Charlie? Because going into these numbers, we talked about concerns around the consumer. We'd get more clarity on the US consumer via Citi, via Bank of America. What did we get?
Big picture, it was kind of, I go back to kind of what Ted Pick at Morgan Stanley said, so pause, not delete. So this view that as long as these trade tensions get resolved quickly, some of the high expectations that we had going into this year could be positive. You got a lot of kind of nautical themes, oddly. So you had Jamie Dimon talking about, stormy seas, but then Jane Fraser, whose bank is incredibly exposed, they're the most international U.S. bank. You had her talking about being kind of a safe harbor in stormy times. So, I think trying to project strength as we hear so much uncertainty coming forward.
You see, Guy actually sails, so he's
not very often
all over these nautical things.
I think everybody's looking for the safe harbour at the moment. Banks are the best performing sector in Europe so far year to date. The sector is up by 13.3%. It is outperforming its benchmark by some considerable margin. We're about to start getting European earnings as well. What is the read across from one to the other? How are we set up going into that?
I think there's going to be less uniformity. I think you have obviously this geographic dispersion. So you've got, potentially different tariff rates on the UK versus Europe. I think you've got, as you say, these kind of tailwinds for European banking. You've got cross-border M&A. If we're in a more uncertain environment, does that get a pullback? You've had buybacks, which have been lifting share prices. If there is pressure on profitability, if there is a slowdown in loan growth, if the consumer is not borrowing quite as much, those buybacks aren't going to happen. So what happens to share prices there? And so I think, it could be a similar story. You might see kind of a positive uplook in some of these trading units at European banks, similar to what we've seen in the U.S. But even thinking big picture, if Europe, gets a deflationary kind of outlook from tariffs as opposed to that inflationary push in the U.S., that also creates, a rate environment that's less positive for lending.
Some of these banks have been posting decent numbers so far this year. SocGen, Commerzbank, TBC, Banco Santander, all up really quite nicely. Charlie, thank you very much indeed. Bloomberg's Charlie Wells on the banking sector. Lines out of China.
Yes, lines out of China, only one, basically. So the only thing to take away from the Foreign Ministry press briefing, the spokesperson Lin Jian saying the U.S. should stop tariff threats and blackmail. This in response to President Trump's, I think his spokesperson read out a statement that he dictated that said that China should come to the table, they should pick up the phone, they should call the United States to try and do a deal. All these other countries.
It sounded like please call us, didn't it?
A little bit, yeah. They were saying the US doesn't need to do this deal, China, you need to do this deal. But yeah, the US calling on China to do a deal and China saying you need to stop with the threats and the blackmail.
And the tone from China, I just think in these kind of press conferences that we've gotten has completely shifted. That is some tough language coming out there. Previously, it was we want to negotiate, we want to have this conversation, we want to have an equal playing field, and that no longer seems to be the driving factor. And then on top of that, we're talking about Donald Trump launching a probe into the need for tariffs on critical minerals. That does include rare earths coming out of China. We're going to dive into the latest with Evie Hambro from BlackRock Fundamental Equities into that conversation. Where does that mean the kind of mining story, the critical mineral story, and of course the gold story lies? We're going to dive into those details next. This is Bloomberg. This is the opening trade. We're 30 minutes into today's session, seeing a sell-off across the equity market. Only down 1%, though. I say only with a giant grain of salt because, of course, we have seen bigger moves to the downside. But a lot of folks maybe liquidating some of their positions ahead of that long weekend on both sides of the Atlantic. Plus, of course, the news that we're getting around Nvidia, some of the tech stocks, and, of course, this ongoing geopolitical risk, Guy.
Let's talk about what is happening in the metals market. A couple of things to say here, one of which is the miners generally have not had a good start to the year, down pretty heavily already. We're watching very carefully, obviously, what is happening with gold. There's a whole precious metal story. And then there's the kind of the latest angle on all of this. I say the latest. It's been a sort of slow, rumbling story. President Donald Trump launching a probe into the need for tariffs on critical materials, minerals, as I probably should say. The latest action in an expanding trade war that has targeted key sectors of the global economy. Evie Hambro, global head of thematic and sector investing at BlackRock Fundamental Equities, joining us around the table. I just want to start here because that's where the news is this morning. We can talk about gold. There's lots of other things to talk about. But China controls this market. America launching a probe into this, isn't it pretty obvious? China produces all of the critical minerals and basically controls the supply chain for them.
So the rare earths market is a very bespoke niche market in terms of the kind of the quantity of supply. It's not like aluminium or copper, which is huge in terms of tonnage. So it's very small, but it's essential.
Yeah.
Everything that we rely on every day pretty much has some exposure to rare earths in it. And then you get some extreme uses in weapons and so on. So, China's position controlling that market, it gives them a lot of leverage. Now, what's a probe going to uncover that we don't already know? Maybe they're looking for something that we don't know about. I don't know. But I think the market's quite up to speed in terms of this. So maybe it's just part of the rhetoric that's coming out of Washington in this kind of long-term, I guess, view that materials are becoming weaponized. They are becoming, there's a war for control of these things because the world needs much more materials over a long period of time for decarbonization, data centers, all the things we know about. And access to these things is becoming critically important to governments. And governments are probably ahead of investors in terms of realizing just what they need to pay to get access to these things.
So that takes me to my next question, which is materials that we require generally for the world economy to keep rolling. The world is becoming more fragmented, so therefore, in theory, becomes more siloed, kind of where this stuff is, and that in theory should be something that is puts grit into the sort of the process of moving this stuff around the world, and therefore probably should imply a slightly higher price. But then I've got a global economy that's slowing because of the same process. That should, in theory, mean that we're going to use less of it, so that implies a lower price. So, how are you thinking about?
Where does it end? Who wins?
How do I balance out the kind of more fragmented, higher price story with the slowing global economy story, which should act as a drag? Where are we in the balancing act of those two things?
Yeah, and the missing item is supply, because that's the other side of the equation as well. So the things you've referenced are mostly around demand. So I think I try to look at it as simple as possible because that gives you a kind of starting point. And you take a commodity like copper today. You've got all of the tensions that you've just mentioned around. Is it going to be positive? Is it going to be negative news? Et cetera, et cetera. Copper's $4.60. That's a fabulous price for copper. That's not a bear market price for copper. So that probably tells you a couple of things. It probably tells you that people are worried about supply. Because where's the supply going to come from in the future? And therefore, could the price fall to too low a level where you start to see, well, actually, we're going to control supply. It's going to go lower because there's not a high enough price to incentivize new production. But it also tells you about what the basic economic activity is. You've got all these macro headlines, but are people still building things? Are we still seeing decarbonization going on? Things might be going a little bit slower than we had hoped for in some areas. Are we still seeing the massive rollout of data centers? Are there more electric cars on the road every day? This is not like bad news as such. There's lots of macro headlines that are a lot of noise, but the underlying economic activity that we're seeing hasn't been significantly derailed. So I'm not too worried about that.
So, Evie, does that mean then the underlying? We talked a lot about the greening of the economy, the electrification of the economy, and all of the metals that were going to be needed to make that happen. The Trump administration creates a lot of news headlines around that as well. But does it fundamentally not look very different to you from how it did under a previous
No, I mean,
administration.
We're very lucky. We get to speak to the companies and find out what their plans are and things, and like everybody does. And, you know, the plans that these companies have are very long dated. You know, just because there's been a short-term change, are you going to stop building the new nuclear facilities to power the data centers? Well, you're clearly not going to stop that. Are you going to stop connecting them to the grid? Are you going to stop putting all of the transformers and everything in to be able to do the supply? Are you going to stop building the data centers? Things might happen a little bit slower, but, you know, they're actually still going in the same direction. You're still seeing the largest deployment into solar and wind in the world right now. You're still seeing huge sales of electric vehicles. Maybe some companies have got lower sales, and you know, some of the ones have got higher sales, etc. So, yeah, at the end of the day, the direction is still moving forward. Okay. And I think that the trend that we've been talking about for so long is that the world economy of the future is far more materials intensive than the economy that we're coming out of, because the economy we're coming out of was way more impacted by fossil fuels. And we're swapping fossil fuels for metals. And that's a trend that's going to last decades.
OK, and what about that other trend that you started the conversation talking about, the sort of regionalisation then of production because of these security concerns around access to critical minerals? How long a prospect, how long a time frame do we need to think about when it comes to trying to get critical minerals produced, extracted and processed, I mean, in the United States, in Europe, rather than bringing them all in from China?
Yeah, and that's a great question, because I think, you know, you can see a lot of headlines saying, you know, we're going to do something really supportive to encourage the development of new supply in the US. But the reality is it takes a long time to build these operations. It takes an even longer time to get permission to build them. And, you know, you can try and fast track and put things through, but if you're trying to cut corners, you're just opening up the game to people who don't want this to happen. And they'll take you to court, and you'll get stuck there for years in a process. So how easy is it realistically to accelerate the development of new supply? I think it's not as easy as maybe some people at senior levels in the government are thinking.
Well, let's talk a little bit about the gold price here, reacting naturally to all the dynamics you've just talked about. I'm looking at 32, we'll call it 32.97 on the precious metal, record high, an all-time record high. What is it responding to? Is it responding to inflation fears that may come from this restructuring of trade, or is it coming from the opposite, a gigantic growth slowdown, recessionary fears?
Yeah, it's a great question. I mean, I'd love to have a pound for every time somebody said it's a record high in gold in the last few weeks.
But
you know, the gold market is kind of thriving in this period of uncertainty. But the foundations are very tangible and real. If you look at the gold market over the last few years, we've seen an extraordinary amount of purchasing of gold by central banks. So central banks became net buyers of gold about 15 years ago, maybe a little bit longer, having been net sellers for decades prior to that. You know, way before even I started doing this job. And we've gone into this market where the amount of buying by central banks now is more than double the annual rate. And it's over 1,000 tons a year in a 3,000 ton a year gold market. That's a huge, huge number. So that's the first thing. The second thing is that the gold market is really starting to thrive now on retail purchasing. And if you look at the data around physically backed ETFs, yeah, they're starting to join the party. So we've got in that real retail buying coming through. And that's outside of the underlying physical buying, where if you go to the US now and you go to some of the big, you know, supermarkets and so on, where you can go and buy gold over the counter, and they're having to restrict the purchases.
In a supermarket?
Yeah, at an individual level. You know, you fill your basket with your milk and your chicken and everything else.
And a gold bar.
And I'll have a gold coin, please.
OK, just a coin.
Otherwise it'd be very heavy.
It would be very heavy.
It'd be very heavy. Quite dangerous getting it home. But you know, so it is extraordinary. So it's got that going on. And then the other thing is that we always like to look at gold and say, yeah, is it actually realistic, this price, relative to its own history? And so, and the way you think about that is say, well, what is the cost of producing it? Are gold companies earning supernormal profits at these prices? And the answer is no. They're earning healthy profits. And that's actually quite sad, because the costs have risen very, very fast. And so for most of the last few years, costs have been rising faster than the gold price has been going up. And companies haven't been earning enough to reinvest, pay off their debt, pay dividends, and so on. And we're now going into this phase where the gold price has broken out into these levels where the companies are actually capturing this higher price in profitability. And we're seeing buybacks being announced by some of the world's biggest gold companies. We're seeing new dividend policies coming through. And we're also seeing this kind of divergence in performance amongst the gold companies, where some companies have been good at capturing these prices and converting them into profitability, and others haven't. And this dispersion in performance has been very, very real. I'm sure your analysts can look at it.
Yeah.
You look at some of the world's biggest gold companies, and it's as if they're in different industries. You know, the share price performance, which is just extraordinary.
Well, you can see it in I mean, just we had a fascinating story, I want to say a couple weeks/months ago. It's all a blur now. But the prices of the gold at the Bank of England versus the prices of the gold at the Federal Reserve is wild. I've got my producer to pull up a chart here of the 40-day price, which is as long as we'll go. But it's basically an exponential chart when you look at the gold prices. And when you see a chart like this, it reminds me a little bit of like Tesla stock or even Bitcoin, arguably. You almost always wonder if that's going to come crashing down. Yeah. And I'm curious what the ripple effect of that is.
Okay, I don't know what the ripple effect would be. I mean, people would lose money.
But is a crash for that kind of volatility coming? When you see a steep hockey stick move like that, could a crash be coming down the pipe?
Yeah, I mean, I think what we're doing is we're in all of these things, we tend to go into new trading ranges. And there's a price discovery process about going into a new trading range. And you've seen it in many commodities. You've seen it in oil and things over the years. And so people test the upside, and then it comes down again and test the downside, and you end up with a consolidation at a new price level. You know, if gold manages to hold $3,000 an ounce for 2025, gold companies will make a fantastic amount of money. You know, the gold funds that we run that are focused on the equities, you know, should do pretty well in that environment. They're already up 40%
until you get
year to date.
Margin calls across the board and everyone liquidates gold, which is what happened 2 weeks ago with the stock market.
Yeah, I think that was more a function of a rush for cash. It was a de-risking that was going on in the market. It wasn't a negative on gold as such. Everything got sold. What was interesting is if you go back to, say, 2008, gold got sold off massively from August through to November. Huge, and there was huge collapse in the market. Gold, you know, if you blinked, you missed the fall in gold last week. You know, it was pretty short. So that tells you that there's this underlying activity. The China news earlier this week about China increasing the quotas to allow more domestic buying of gold. Yeah, they wouldn't be doing that if they thought the gold market was going to go into some kind of crazy territory and would damage domestic investors. So, you know, you kind of put it all together and you look at gold relative to the cost of production, gold relative to its purchasing power. I don't know whether you guys have seen the data around the iPhone. You know, so when the iPhone was launched 16 years ago, it cost about $500 to buy an iPhone. You know, if you said, well, how much gold would it cost to buy an iPhone back 16 years ago, it would be a certain amount of gold, about 0.28 of an ounce. An iPhone today, the new iPhone, is about $1,500 an ounce. So it's gone up 3 times, and these fabulous banknotes that really look after your purchasing power through time. In gold, it costs you 30% less gold today to buy today's iPhone. So what has been the better way of storing your wealth and preserving your purchasing power through time? And I think young people today are learning, painfully, this lesson around the devaluation of paper currencies. And you look at, you know, U.S. government debt going to new highs. I mean, you could talk about new highs in U.S. government debt and new highs in the gold price in the same sentence. And you look at it around the world, the servicing cost of this, the higher rates. Okay. And what brought the U.S. government back to heel last week was the move in the bond markets. Yeah. You know, and, you know, the servicing of this huge debt mountain.
Are we doing a full kind of reverse on Nixon, maybe at some point? We'll maybe get back there.
Evie, thank you very much.
No worries. Thanks for having me, yeah.
Evie Hambro, Global Head of Thematic and Sector Investing at BlackRock Fundamental Equities, with a lot to say on gold. Coming up on the programme, UK inflation slipped lower for the second straight month. We dig deeper into today's data. Jumana Salehin joins us, Vanguard Chief European Economist. The market moving to factor in a bit more rate cutting, it seems, from the BOE. We'll talk about that shortly. This is Bloomberg.
Welcome back to the opening trade. 47 minutes into today's session. I think what you need to know this morning is that equities are selling off and bonds are catching a bit. Of course, the geopolitical risk framing all of this. So let's get right to that story. The European Union and the U.S. making little progress bridging those trade differences this week. The Trump administration indicating that the bulk of the tariffs imposed on the bloc will not be removed. Bloomberg's Oliver Crook following the story in Berlin. He joins us now. Ollie, walk us through the readout from the meeting.
Yeah, Kriti, so listen, this is really the week in which the European officials are being sort of thrown at the Trump White House to try to make a breakthrough in terms of any kind of negotiating, getting any kind of picture of what the Trump administration wants. It began with Mauro Sefcovic on Monday, meeting with Jameson Greer, Howard Lutnick. Yesterday, we had Carlos Cuerpo, the Spanish economy and trade minister. And on Thursday, it's going to be Giorgia Meloni heading to the White House to have a direct meeting with Donald Trump. But we got a little bit more information of that main meeting of the week between Mauro Sefcovic and the Commerce Secretary, as well as the U.S. Special Trade Representative. And what he left with, Mauro Sefcovic, is not much more of a clear idea of what the Trump administration actually wants from the Europeans. So the Europeans are in this position where they don't really even know what they're negotiating with. But I think the bigger concern for them is they don't know exactly what they're negotiating for. How much willingness is there on the U.S. side to reduce those tariffs that exist on steel, aluminum, autos, 25%? We know those are sort of sacrosanct sectors for the Trump administration that they may actually not even be willing to negotiate for. And on this sort of 10% reciprocal tariff, are they trying to get that 10% down, or are they just trying to preserve that 10%? Because remember, after that 90-day period, you're going to get that number go up to potentially 20%. So it's not clear for the Europeans what they're negotiating for, what they're negotiating with, to say nothing of the fact that before that 90-day period, you might get a whole new litany of sanctions and tariffs on things like semiconductors, on things like pharmaceuticals, and of course now critical minerals.
So what does Giorgia Meloni need to do tomorrow? What are her expectations? Does she have a better chance than others, in some ways more ideologically aligned with the Trump administration? What are we looking for from that meeting?
Yeah, I think it's going to be the key meeting in a certain sense. I mean, I think that what we've seen about the personal relationships with Donald Trump in terms of making headway in trade negotiations, that may not be terribly encouraging. We look back to that meeting with Benjamin Netanyahu a couple of weeks ago over at the White House. But we'll have to see. As you say, Guy, Giorgia Meloni is the closest sort of political ally in a major European country, most ideologically aligned with Donald Trump. They have a good personal relationship. And as you know, you never really know with Donald Trump. Potentially there's a way of getting through. For her, it's maybe just a fact-finding mission to try to get an idea of what this Trump administration specifically wants from the Europeans. And we should say that she's also welcoming J.D. Vance on Friday within Italy. He's coming for a sort of Easter visit. We'll remember his last visit at the Munich Security Conference and what he had to say there. But I think at the end of the day, if you really want to look for progress in trade negotiations between the EU and the United States, you may not look at the politicians. You may look at long-term U.S. Treasury yields and Eurodollar to see really the thing that seems to push the Trump administration to the table.
Ollie, thank you very much. Bloomberg's Oliver Crick with the latest on the EU trading position. Let's talk about the European economy then. Joining us now, Jumana Salehin, Chief European Economist and Europe Head of Investment Strategy Group at Vanguard. Jumana, nice to speak to you this morning. So that's the tariff conversation where we've got to so far, and there's a lot at stake, of course, for the European economy when it comes to that tariff conversation. How much of a slowdown in the growth story are you expecting in Europe? Or, just like lots of businesses we're hearing from at the moment, is it just impossible to say?
I think for Europe, we are expecting a slowdown. So when we look at, the European outlook, we look at the recent data. That will tell you where it's going. But on top of that, we'll also look at the news around tariffs, and that will have, a negative impact on uncertainty, business confidence, which will be a drag. So our own forecast for the euro area in 2025, we've downgraded it to 0.8, so less than 1% is what we're looking at.
And what role the stronger euro at this moment, what role is that playing? Should the ECB, and let me tie that into a rate cut question, because should the ECB be thinking about cutting more than 25 basis points to shore up the economy as a sort of preemptive measure, and mindful of the fact that the euro has already strengthened quite a lot?
Yeah, absolutely. When the euro strengthens, that's actually going to be, pushing down on inflation, because the important prices become cheaper, and so you see that effect. There's also another effect from trade. If trade gets diverted from the US to the euro area, you see more cheap imports there, and we know that that also drags on inflation. So these two factors are going to be looking down on inflation. For us, we're expecting the ECB to cut tomorrow, and we're expecting them to cut again later this year in the summer. Whether that's July or September remains to be seen. But the main point to remember is that the ECB interest rate is going to be now close to what is called the neutral, so no longer restrictive territory. And that's really where we expect those interest rates to settle, with inflation kind of going back towards trend. And growth is going to be a little bit weaker. So that's really where the uncertainty is on the growth side.
So it seems like, I mean, consensus here, and you just said it there, is that we're anticipating a wider divergence between the ECB and the Federal Reserve. If you look at the currency market, though, your dollar is pricing in the exact opposite. Are we due for some sort of snap? How long can the ECB sustain that divergence from the Fed?
So I think that's a good question. And I think that really when you look at the currency moves, there's two things that are at work, Kriti, right? There's the interest rate differentials that work, but also what we think of as the long-term sustainable interest rate, right? So there's an anchor there. And so when you see that interest rate differential, can it be persistent on a short-term basis? Absolutely, yes. But you could see also some of those long-term factors, people re-evaluating what the prospects are for the euro area in the longer run, what the prospects are for the US in the longer run, and that could also drive that persistence. But it can't go on forever and ever, right? So the interest rate differentials, ultimately, at some point you would expect, otherwise you'll see it in the currency moves.
All the data at the moment seems to come with ifs and buts. Like the Chinese data this morning, it comes before the tariff hit comes through. The Bank of England, the UK data this morning, we'll talk about the Bank of England in just a second, comes before a massive inflation hit comes through in the form of energy bills and all the other bills that we're apparently about to see hitting our doormats. What do you see happening with the Bank of England at the moment? How does it navigate a better trajectory with tariffs, an inflationary shock that continues in the UK, at the same time as a growth story that doesn't want to pick up? I know it's better than anticipated, but doesn't want to pick up. What do you see the rate trajectory looking like? Because the market continues to price in rate cuts from the Bank of England, but it's just so unclear as to whether or not they're going to be delivered or not.
Right. Quite a few questions there. So I absolutely agree with you. Ifs and buts. We're at a time of heightened uncertainty, and that's why we have those ifs and buts, because, you know, it depends on what happens, and there's quite a few things changing, particularly in the policy sphere, which can be really important, right? The policy is the big thing which drives it. If the data is 0.1 up, 0.2 down, people can look through that. How do you navigate this? Of course, they always look 2 years ahead when they're setting interest rates. And so based on that, they'll be like, OK, where do we see the fundamental drivers of the economy? And the fundamental drivers of the economy are, yes, weak growth this year, but over time, you know, some recovery. And then on the other side, the inflation is going to be higher this year. But as you say, that weakness of demand brings that inflation down next year. So if we think about inflation, where it's going to end this year, it's going to be above target, but by the end of next year, below target.
The forecasting variability is enormous at the moment, though.
Absolutely.
So isn't the temptation, shouldn't the central bank just be sitting on its hands, trying to basically do as little damage as it can at this point before knowing which way to jump? Like, it might have to jump higher, it might have to jump lower. There's so many risks around at the moment.
So what they will be doing is that, you know, the fundamentals are really looking ahead. It's really growth that's going to determine the inflation picture next year, right? And we know that monetary policy acts with a lag. So they can't sit on their hands now, because if they do, they'll miss their opportunity. The weakness in growth, which is global, like globally we're dancing with a recession. We see growth below 1% in major advanced economies. And as you said, China's coming out weaker as well. So with that picture, we know at the end of the day that's going to weaken the spending power that individuals have. And so you know that already, and so you think ahead. So we are expecting the Bank of England to cut at the next meeting and to have 2 more cuts this year on top of May. So that's 3 cuts this year.
Joanna, great to see you. Thank you very much indeed. Joanna Salahin, Chief Economist at Vanguard. What's for the rest of the day? Powell's coming up a little bit later.
Yes, he is. And in the meantime, US futures are weakening. We're touching session lows again on Nasdaq futures. Back to the tech conversation that we started the programme with, down by 2.3% there. That's coming up. Gold is rising once again, a new high. Don't know if it was something that Evie Hambro said, but the gold price keeps on getting higher.
Arsenal are playing Manchester. Arsenal are in Madrid tonight. That's the kind of the main story coming up. Can they defend that 3-0 lead that they currently have? Scott Kirby is a great conversation. It's coming up later here on Bloomberg. Looking forward to hearing from the United CEO. This is Bloomberg.